Hello and welcome again. In this lesson we will look at the additional aspects of employment income. We are still at employment income. In the previous couple of lectures we looked at the employment income and the benefits as well, which are part of the employment income. You know that there were lots of benefits which we have seen. There were about 42 benefits which we have learned the rule for, and the final rule which we have studied was the residual charge. Now what does that residual charge tells us? It says that when you do not study any rule about any specific benefit, then this rule will apply. Alright, so say for example you see a new benefit in the exam hall and you say, oh my god, I haven't studied any rule for this benefit, then that will help you. Rule number 42, I think, that was residual charge, which is going to be relevant there. Alright, so there were different sorts of benefits. So employer can give you accommodation, they can give you car, and they can give you laptop or iPad, anything else. Right, so there were lots and lots of benefits. Now apart from them benefits, employer can give you shares as well. Now in this lesson we will look at if the employer gives you any shares, how to calculate the benefit. Obviously if employer is giving you shares, that will be a benefit if you have paid less than market price or if you haven't paid anything at all. Alright, so we will have to calculate that what is the benefit for employment purposes. And obviously if it is a benefit, then you will have to pay tax on that as well. Right, so let's look at the benefit on shares. So say for example if employer gives you a share and he says that whatever the market price is, you pay me less than that, so that amount which you pay will be deducted out of the market value and the remaining one will be the benefit. So we'll take the market value of shares, and we'll deduct price paid by employee. Price paid by employee will be deducted, and this figure is going to be our employment income benefit. That is our employment income benefit, and it will be taxable as well. Now say for example, obviously whatever the market price was, if it is going to be a benefit, then you will have to pay less than market value, right? So you might have to pay less than market value, or in some cases you might not have to pay anything at all. So if you pay nothing, then the whole amount, which is the market value of the shares, will be the benefit. Alright, so that is the way to calculate when employer is giving you some shares, and it is very, very obvious anyway. So whatever the market price is, you are paying less than that. Why are you paying less than that? Because you're employee. That is the benefit. Alright, so whatever the net amount is, that is going to be the benefit. Alright, now that is about the shares. So when you buy the shares from the employer, sometimes you because the employee is working for that company, and employee is reluctant to buy the shares because they think that, I don't know what would happen in the future about that company, so he's not sure about that. In circumstances like that, the thing which is option is going to help that employee and the employer. Alright, now you have studied options at P4 and F9. If you haven't chosen P4, don't worry, you have studied at F9 anyway, options and futures and all that. Say for example if you are exempt from F9, now options simply mean that you pay something now, and you say to, if you say for example if you buy an option, now you have an option to buy the shares in future of that specific company. Alright, now options simply mean that you are not bound to buy the shares, but you have the option, you have the choice. If you want to buy the shares in future, you can buy. If you do not want to buy the shares, you won't have to buy. But obviously when you're buying the options, you will have to pay a nominal amount for the options. Alright, now say for example if I'm not sure about I don't know, Apple, and I want to buy the shares in Apple, I can buy the shares, but I can buy the options as well if they allow me. Alright, so if they gave me the option to buy the shares in Apple, then what I will do is I will buy few options. Alright, so say for example if I buy an option to buy the shares, to buy 1,000 shares after some time, after say for example 2 years, then I will pay for the options. So when the time comes, say for example after 2 years, then I will see that what the share price is. Now that share price, if it is attractive, then I am going to buy it. Now what amount I will pay? I will not pay the amount which I will not pay the amount when I'm exercising the shares, when I'm buying the shares, but I will pay the amount what was agreed when I bought the options. All right, so that is the benefit. Otherwise, it is not going to be benefit anyway. All right. Now, say for example, if an employer gives options to employee, what would be the benefit at that time? How to calculate the benefit in them circumstances? Now, that is a different way. So what will happen is we'll take the market value again, market value of shares. So we'll take market value of shares, and then we'll deduct a price paid. We'll deduct that, and also additional thing we'll deduct is price paid for options. Price paid for options, if any. If any. All right, so it will also be deducted. Now the net amount is going to be our benefit if the options are granted. All right, so if the employer is giving you options, that will be the benefit on the exercise date. All right, and that is the benefit on the exercise date. Now, what is the difference between exercise date and a grant date? Could you please tell me what the difference between exercise date and the grant date? Now, the grant date is a date when the shares were granted to you. Say for example, when the options was granted to you. Say for example, if you said I want to buy the options, that is a grant date when the company is giving you options, correct? Now the exercise date is the date when you eventually buy the shares. All right, so it will be a tax benefit when you are going to buy the shares. So that is the exercise date. All right, and this amount is going to be our taxable benefit. All right, so it is our taxable benefit, and that is only on the exercise date. Now, say for example, if we talk about options, and we're talking about options, but I've told you about exercise date. Now, could you tell me that what would happen on grant date? Now, say for example, if it is a grant date, would there be any tax benefit on grant date? Now, grant date is the date when the options were granted to you. So you were giving the options to buy the shares in the future. On grant date, there is no tax benefit, so we don't have to do anything on the grant date. However, on the exercise date, there will be tax benefit. So on the exercise date, in order to calculate the tax benefit, we take the market value of the shares and we'll deduct the price paid for the shares and the price paid for the options, and the net amount is going to be our taxable benefit, and this will be our employment income benefit. You can say our taxable benefit. All right, so that is the way to calculate the value of the shares, and this will be the amount which will be taxable. Now, apart from that, there are few schemes which are tax advantaged schemes. So say for example, if you buy the shares through that scheme, if it is operated by the employer, then you will have to pay less tax in some cases, or you might not have to pay any tax at all. Now, when I say any tax at all, I mean not only income tax, NI, but I also mean CGT. So you won't have to pay any tax. So you do not have to pay income tax, NI, and capital gains tax as well. All right. Now, them are tax advantaged share schemes. Now, let me share the screen with you. Actually, before sharing the screen, I will just try to explain it to you on the board. Now, first scheme which we are going to study, first scheme is called SAE, Save As You Earn. Save As You Earn scheme. I'll just write down the names here because I cannot write everything on the board. I will explain, we will read it together anyway from the notes. So I'll just try to explain a little about all the schemes which we are going to study now. I will just write down the name. So first scheme is SAE, Save As You Earn. Now, like the name says, save as you earn, it means that when you are working for someone, you are earning some salary. So when you're earning some salary, you are saving some amount out of your salary, right? So that is the way these schemes work. So you are being paid the salary at end of the month. Out of that salary, you put something towards the option, say for example, and you are putting that amount towards the options, right? So you are saving that money. Now, although you are saving that money, but you are not bound to buy the shares, right? So you are being paid the salary, but before you are being paid the salary, you ask your employer. Now, because your employer is operating this scheme, say scheme, so you said to your employer that, all right, I want to be part of that scheme. So he will deduct you, the employer will deduct a minor thing which is agreed out of your salary, and they will contribute towards your say scheme, right? Now there are different conditions about the say scheme. We will see in a minute when we move to our notes, right? But say scheme, in the say scheme, you can contribute from £5 to £500. It is up to you, right? So you can contribute whatever amount you want, but minimum is £5, and you can contribute up to £500, right? Now, when you're contributing this amount, you are buying the share, so you're buying the options, all right? So you are saving this amount, and what happens is that you are saving this amount for a specific period of time, initially for 3 years. So you're saving this amount, and when the 3 years are gone, so after 3 years, what would happen is that you can either withdraw that amount, excuse me, you can either withdraw that amount, or you can buy the shares if you want. Right, so what would happen is that you can either excuse me, you can either withdraw the cash which you have saved, or you can just buy the shares of the company, whichever you prefer. Now the question arises that when you are saving this amount for this say scheme, although you are going to benefit because you have the option to buy the shares, but what benefit the company is getting in return? Obviously, company is keeping your money every month or every year, so whatever amount they are keeping, that is your money, right? So they are taking out of your salary, they are keeping it, and they will keep it for a specific period, initially for 3 years, as I said. Now, because they will keep that money for 3 years, they are not, they will obviously do something with that money. Even if they put that money into the bank account, they are going to earn some interest. Now, will they pay you something on that money? Obviously they will. Now company will pay you some bonus as well on that, while you keep that money with the say scheme. So what benefits are you getting? You are allowed to contribute from £5 to £500 in say scheme. You're not bound to buy the shares, but you have the option to buy the shares after 3 years, which is the initial period. All right. Now, if you want to buy the shares, you can buy the shares, or if you don't want to buy the shares, you can simply withdraw the amount. Now, what you have paid, say for example, you have paid £500. Now, what you will get is not £500, but on top of that, you will get some bonus as well, because your company has used your money for 3 years. All right, so that is a very, very good scheme, to be fair with you. Now, after 3 years, if you want to keep the money within the company, you can keep the money within the company, within the say scheme, for another 2 years. Now, if you are willing to keep the money in the company for another 2 years, then another bonus will also be added by the company. Correct? So that is that will be very, very good for you if you do so. Excuse me. Now, when you invest in this company, and if you keep this company for a specific period, then you will not have to pay any income tax or other taxes on that one say scheme. All right, so there is a minimum holding period. So if you keep that, if you keep the say for example, if you buy the shares and if you keep the shares for some period, then you will not have to pay any tax at all. All right, so that is our excuse me, say scheme. Another scheme is a company share option plans, CSOPs. I'll just write it down here. Company share option plans. So this means company share option plans. Company share option plans. All right. We will see the difference between these two in a minute when we move to our notes. Next scheme which we are going to study now is Enterprise Management Incentive, or just let me write it down as EMI. Enterprise Management Incentive. Please make sure you write down full form, which is Enterprise Management Incentive. Now what would happen here is, in this company as well, you give the shares to the employees. Now these are not normal employees, as the name says, Enterprise Management Incentive. Management and incentive. Now incentives mean simply when you want to motivate the employees, you give them some incentive, right? Now management simply means that it is a high level management. So these shares will not be issued to normal employees. These will be issued to big people, the directors of the company. So top level management. So what would happen is in this scheme, why this scheme is issued, why these shares under this scheme are issued. The reason behind is that, say for example, if you want to register a new beverage company, and because you are a new company, so you need a experienced marketing person. So what you do is you approach a person who works for Pepsi, say for example, and you say, could you please come to my company and I will give you this much salary, this much benefit and all that. Now that person will still be reluctant to come to your company even if you offer a higher salary, because salary is not the main thing. Another thing which is important to most of the employees is reputation of the company and job security, because yours is a new company, so you never know that when this company is going to end up. However, if you compare it to the Pepsi, so he has already got the job and it's a secure job as well. So he will be reluctant to come to your company even if you offer a higher salary. So what would happen is that, because you want to, you don't only want him to come into your company, but you also want him to work very well in your company. So what would you do is, on top of the salary, you would offer him these shares, which are Enterprise Management Incentive. So you will give them some shares. So in order to give this on top of the salary, you will give them some shares, so that when they perform well, the share price of the company will also go up. So obviously they will be working very hard so that the shares can go up and they can benefit as well. So these shares are not issued to normal people, normal employees. These are issued to well settled people who are directors and top level management. All right. Next one and the last one is share incentive plans. I'll just write it as SIPs. So share incentive plans. Now these are also these are also issued to, because it says incentive plans, so these are also based on the incentive. So what would happen is that if employer first gives the shares to the people, to the employees, and it gives some target as well, so that he wants the employees to work very hard, and then he can give you some shares. So initially he will give some shares, and then on top of that, what the shares are already issued, say for example £3,600 in this case, so employer will give you £3,600 worth of shares, and then he will also say you can buy more shares as well at the discounted price. All right, so then employer can buy more shares at the discounted price as well. Now on top of that, matching shares are also given. Matching shares simply means that whatever shares they hold in the company already, and they can get more shares on them shares, which are bonus issued, basically whatever you have studied previously, like the bonus shares. So it is kind of a bonus share. So the people who already hold the shares in this company, they will also be issued some bonus shares as well. All right. Now I will just share the screen with you so that we can read it through the help of notes, and you would understand it in a better way. As you can see on your screen now, that is chapter number 1, employment income additional benefits, additional aspects. The first thing which I told you, that how to calculate the benefits when the shares are given, it is as I showed you on the board. So what would happen is that excuse me, we'll take the market value of the shares, and whatever the employee has paid, that we'll deduct that amount, and the net amount is going to be the benefit to the employee, and that will be our taxable benefit. Let's say, for example, if the share options are granted, on grant date there won't be any tax liability. If it says if a director or employee is granted an option to acquire shares in the future at a price set now, and then there is no income tax charge on the grant of the options. So as I said, there will be nothing on the grant date. However, when we go to exercise date, there will be tax benefit, and it will be equal to, we'll take the market value, we'll deduct whatever he has paid for the options, and we'll also deduct the amount which he has paid for the shares, and the net amount is going to be our taxable benefit in this case, and only on the exercise date. Now exercise date, as I said, will be the date when the shares are eventually bought, and grant date is when the options are granted. So first scheme, a SAY scheme, which I said, save as you earn scheme. It says save as you earn scheme option, save as you earn share option scheme allows employees to save regularly monthly for a fixed period of time, and use the funds to take up options to buy shares free of income tax and NIC. So as I said, they can buy the shares free of charge. So free of charge means free of income tax and national insurance contribution. Alternatively, they can simply take the cash saved. So whatever amount they have saved, they're not bound to buy the shares. There is a choice for them to buy the shares. If they don't want to buy the shares, they can simply withdraw the money. Now, how much can they invest? Excuse me. From £5 to £500, that is the amount that they can pay every month. So from £5 to £500 they are allowed to pay, and the investments are made for 3 to 5 years. So it says 3 or 5 years. So initially they will be for 3 years, and if they want to keep it for another 2 years, and it is up to them. And tax-free bonus is then added by the employer. So whatever amount you have paid, you will not only get that amount, but a bonus will also be added. The employee may either withdraw the money or leave it for another 2 years. So it is up to you. You will initially be in the scheme for 3 years. If you want to do it for another 2 years, it is up to you. If you do so, if you keep it for another 2 years, then another tax-free bonus will be added. Then it says at the withdrawal date, the employee may take the money, alternatively may use it to buy the ordinary shares in his employer company. The price of these shares is fixed at the date the option was granted, obviously. Now there is a condition that when the options are granted, we will set the price on that date, but the price which you are giving to employee must be 80% of the market value. So for example, market value at the option grant date was £1, so the minimum you can issue is at the rate of 0.80. Right? The next one, it says the only tax charge is the capital gains tax when the shares are finally sold. So capital gains tax is another type of tax. So when you sell the shares, you will have to pay capital gains tax in this scheme. And only when the shares are finally sold. Alright. Next one, it says, just bear me 1 second. The scheme must be open to all employees and full-time directors. Now this scheme, SAY scheme, is open to all employees and full-time directors, so there is no restriction. However, if you want to do so, a minimum service period of up to 5 years may be imposed as eligibility condition to join the scheme. Now this scheme is although open to everyone, to all employees and full-time directors. And now when it says all employees, means all employees, but when it comes to directors, part-time directors are not allowed, only the full-time directors. So this scheme is open to all employees and full-time directors. However, on top of that, what you can do is you can set as eligibility criteria of minimum engagement period, minimum engagement period with the company. So say for example, whoever worked for 5 years will only be eligible for this company. So minimum service period of up to 5 years. So it does not mean that only 5 years, it means up to 5 years, so you can set 3 years as well. And finally, the cost of setting up SIPP scheme is deductible as trading expense. Now obviously when you set up this scheme, if you're a company, you set up this scheme, there will be some cost involved as well, and that cost will be deductible as trading expense, and so your profit of the company will be lower, you will have to pay less tax. Now all these schemes which I have shown you on the board and which we are going to study now as well, SIPP scheme, whether it be SIPP, ESOP scheme, SIP or EMI, and in all of these schemes obviously there will be setup cost. So whatever the setup cost is, cost of setting up this scheme, that will be deductible trading expense in all cases. All right. The next one is company share option plans. Excuse me. Now an employee can be granted options to buy shares under ESOP. There is no income tax or NIC on the grant of the company share option plan, so there is nothing on the grant date. However, there is also no income tax and NIC. Now there is a minimum holding period, so if you exercise the shares between them period, then there will be nothing on the exercise date as well. So nothing on the exercise date, no income tax and NIC. So what is that period? That is between 3 years and 10 years. So if you exercise the shares within 3 and 10 years, then you will not have to pay any NI or income tax liability. Excuse me. Now tax exemption is lost if the shares are exercised between 3 years or after 10 years. So if you keep these shares, if you exercise these shares between 3 and 10 years, then it's all right, you don't have to pay any income tax or NI. However, if you exercise between before 3 years or after 10 years, then it will be withdrawn. Only CGT will apply to the profit on disposal of the shares. So CGT will apply. Now there are certain conditions for this company. What are them conditions? Now, the price of shares must not be less than their market value. Now, could you please tell me in SIPP scheme what was the rule about the price? Yeah, you're right. The rule about the price under the SIPP scheme was that price must not be less than 80%. Excuse me. Price must not be less than 80% of market value at the date of grant under the SIPP scheme. Whereas under ESOP scheme, a price must be 100% of the market value. So it says price of the shares must not be less than their market value at the time of the grant. The total market value of the option granted to an employee must not exceed £30,000. So maximum you can grant to one employee, the options maximum option which you can grant is worth £30,000 worth of shares. Then it says a scheme need not be open to all employees. Now in the previous one it said that this scheme will be open to all employees and full-time directors, whereas in this one it says the scheme need not be open to all employees. Also minimum service period of 18 months may be imposed as eligibility condition to join the scheme. In this one it says minimum service period is 18 months, whereas in the previous one it was 5 years. All right. Then it says if the company is a closed company. Now what the closed company is, I will tell you in a minute. Basically, closed company is a company which is owned by a close family members. For now, just understand it as a close family member owned company, and there is a separate chapter on the closed company when we move to the company's tax. But for now, the closed company simply means a company which is owned by the close family members. So if the company is a closed company, then anyone who held 30% of the shares of the company in the previous 12 months, and this person must be excluded from this scheme. So that is also one of the ESOP's condition. Again, it says about the cost. Cost of setting up will be deducted. As I said, it will apply on all of the schemes. The next one is enterprise management incentive. As the name says, it is from management incentive. This scheme is intended to encourage experienced people to take the plunge and leave established careers in large companies for riskier jobs in smaller startup and developing firms. Like I gave you the example of our own firm, if we are going to start a new business and we want experienced people who are working for our competitors, who are working for our benchmark competitors, then obviously they will be reluctant to come to our company. So this scheme is intended for them. Excuse me. A qualifying company can grant each of its employees options over shares worth up to £250,000 per employee at the time of grant, and is subject to a maximum of 3 million in total. So in total it will be less than 2 million, and per employee £250,000. There won't be any income tax or NI on both grant or exercise of the options, provided the exercise takes place between 10 years. So what would happen is that if you buy the options and you exercise the shares, so you bought the options and you have bought the shares as well within the 10 years, then you won't have to pay any tax on exercise date as well. Excuse me. If the options are granted at a discount rather than market price, now what was the rule for the previous ESOP company? You cannot give the discount. It will be 100% of the market value. What was the rule in ESA scheme? 80% of the market value. Whereas in this one says you can give the discount, but if you give the discount, there will be tax charge. So there will be tax benefit. So it will be market value at the time of grant less option exercise price. So whatever the difference is, and that will be the benefit. Excuse me. Next one, it says an employing company may set a target. Obviously they will set some target, so may set a target to be achieved before an option can be exercised. The target must clearly be defined at the time when the options were granted. Now when the shares are sold, the gain is subject to capital gains tax, which is CGT. Capital gains will be calculated as sales proceeds less market value of the time of grant. So it will be calculated always in this way anyway. We will see when we move to our capital gains tax, we'll just take the sales less the cost which we have paid for it. So in this case it will be sales less market value at the time of grant, which will be the amount which we have paid, obviously. So it is a normal way to calculate CGT. And CGT will be calculated according to the normal CGT rates. Now what is a qualifying company for this one? So qualifying company for this one is it could be quoted or unquoted company, and its gross assets must be less than 30 million pounds. The company must not be under the control of any other company. It cannot be subsidiary of another company. The company must have less than 250 full-time equivalent employees. So 250 equivalent employees means that if there are part-time employees, then it should be 500 part-time employees. And who are eligible employees? Employees must be employed by the company for at least 25 hours per week. If the employees are working, now eligible employees will only be the ones which are working for 25 hours a week. And if any employee holds 30% or more shares in the company, and that must be excluded. Now the last scheme is a SIPP scheme, which is a share incentive plan. And in this one, what happens is that employee gives up to £3,600 worth of shares, and it will be free of tax and national insurance contribution. Employee can set a performance criteria, obviously he will do, or target to be met in order to be eligible for free shares. Now after having free shares, employees can purchase partnership shares. Now what are partnership shares? Partnership shares simply means a same thing. These are same shares, but when you are buying for your own money, then these are called partnership shares. Employees can purchase partnership shares through deduction from the salary up to the lower of 10% of salary and £1,800 in tax year. Now there is a mistake here in the notes. Please make sure you rectify it. It says off here in the notes before £1,800. It's and here. It actually is and. So from salary up to lower of 10% of salary and £1,800 in the tax year. Employers can award matching shares free of charge to the employees who already had the partnership shares. Now, as I said to you earlier, these matching shares are bonus shares given to employees who already hold the shares. So these are bonus shares. But the ratio to get it is 2:1. Now, SIP shares must be offered on similar terms to all employees who participate in the shares. So it must be on the similar terms to all employees. Now, shares must be held for at least 5 years normally. Now, if the shares are sold within 5 years, they will be charged to income tax and NIC on the market value of the shares at the time of withdrawal. If the shares are taken out of the plan after the 5 years, then there will be no charge to income tax and NIC, and there will be no CGT if the shares are immediately sold. So if you sell the shares immediately, then there will be no tax no capital gains tax as well. After that, it says dividends of up to £1,500. Please make sure you just delete this 1,500. There is no limit on that. All the dividends are tax free as long as you have reinvested them. So dividends on shares, just write it down as like this: dividends on shares in the plan are tax free, provided the dividends are used to acquire additional shares in the company, and which again must be held in the company for 5 years. It says 3 years here. Please make sure you write it down as 5 years. So what would happen is that dividends are tax free, and as long as you have used them dividends to buy another shares, which will be again in the plan for another 5 years, right? So dividends will be tax free if you have invested them dividends to buy the shares, which them shares will again be in the plan for another 5 years. So there are a couple of mistakes here. There is no limit of £1,500, and another thing is that these shares must be for 5 years, not 3 years. All right. After that, it says payment of termination payments, payments on termination of employment. Now, what would happen is that when you finish with an employment, so you're going to either another employer or you are leaving the country or whatever, so you finish with that employment. Say, for example, if I leave Account Institute and if they pay me some payments, then payments are called termination payments. All right. Now, termination payments are divided into 3 sections. One will be taxable, other one will be exempt, and the last one will be partially taxable. So first we will read the exempt ones. So which ones are the ones which are exempt, so you don't have to pay any tax on them? So payments on account of injury, disability or accidental death. Lump sum payment from a registered pension scheme. So lump sum payment will be exempt, which you receive from the registered pension scheme. Now in here, lump sum payment, you remember 25% of that is exempt. If you receive excess of that, obviously that will be received as employment income. So lump sum is exempt, but it will be 25%. Then it says legal costs covered by employee from employer following legal action to recover compensation for the loss of employment. Now, say for example, if you have been kicked out of the company and you sue that employer, so if you win that case, that cost will also be recovered, whatever you have incurred in that specific case. So the legal costs are recovered by employee from the employer following legal action to recover compensation for loss of employment. The next one is fully taxable. Now, whatever you have been mentioned in the contract, whatever amount you get on that, that will be fully taxable. So what are those? Payment for work done, terminal bonuses for doing extra work during a period of notice. Say for example, if your boss gives you an extra work and he gives you some payment on that, that will be fully taxable. Payment in lieu of notice, we are stated in the original contract extending a period of notice. So say for example, if your boss asks you to stay late during a period, and that will also be taxable. A payment by one employer to induce an employee to take up employment with another employer. Say if your boss asks, say for my boss asks me, alright Faz, could you please go to another college as well and deliver a lecture there? If they give me payment on that, and that will be taxable. Then it says payment from registered pension schemes, payment from unregistered pension schemes, and that will be fully taxable. An employee accepting a limitation on his future contract or activities in return for a payment, which are known as restrictive covenants. If you're being paid for that, that will be also fully taxable. Now, what would happen is that restrictive covenant simply means that when you finished employment with someone, you cannot work for any other person for a specific period of time. All right, so that is known as a restrictive covenants. Now, ACCA applies restrictive covenants on the markers, whoever is on the examiners. So whoever the ACCA examiner is, they cannot go to do another job after some period when they finish being the ACCA examiner. All right, they cannot go to be employed somewhere else after finishing the ACCA examiner for some period of time. This is known as restrictive covenant. So obviously ACCA will be paying them for sitting at home, so that will be fully taxable. All right, next one is partly taxable. Now, partly taxable simply means that first £30,000 of this amount will be exempt, and on top of that will be taxable. Now, what are them payments? First one is ex gratia payment. Excuse me, just pay me 1 second. First one is ex gratia payment. Now, ex gratia payment simply means that amount which is given out of goodwill. Say for example, if you're leaving that company and the employer does not owe you anything, but he still gives you some amount, so that when you go out of the company, because you have worked so hard, so he just gives you an extra amount because he thinks he should just give you. All right, so I mean, it normally does not happen. If your boss is very, very good, then obviously he's going to give you some ex gratia payment. So this is the amount which normally employer does not owe you, so he does not have any liability to give you, but he still gives you, so that when you go out of the company, you will speak good about the company, won't you? Next one is a compensation for loss of office. It is also partially exempt. Payment for unfair dismissal, it is also partially exempt. Statutory redundancy pay is also partly exempt. Any other benefits like mobile phone, computers, etc., provided calculated on the normal benefit rules under the terminal payments, is also going to be partly taxable. Employer have an obligation to report termination settlement to HMRC by 6th July following the tax year end. So for our current tax year, it is 6th of July 2017. Right? So that is our end. That is end of our chapter. Now this chapter is very, very important as far as these schemes are concerned, and please make sure you do not confuse these schemes with other ones. Now, SAY scheme was examined in previous exam sitting. CSOP was examined as well from one of the previous exam sittings, and the EMI also was examined in one of the exam sittings as well. And especially EMI, if we talk about, many students confuse it with the Enterprise Investment Scheme, which is EIS, which is a tax reducer. Please make sure if it you find it in the exam hall, do not confuse it with the EIS. EIS is a tax reducer, whereas enterprise management incentive is a tax advantaged scheme. So when you invest in that scheme, you get some tax advantage. All right, so that's it for this video, and I will see you in the next video, and we will see more interesting stuff for ACCA P6 taxation. Thank you. Goodbye.